Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, premiering May 24th and 31st. Check out these two exciting two-part events, which we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials.
Hey everybody, it's Larry Berman here, coming to you late Friday afternoon, just prior to the U.S. market closing. It's a happy long weekend for everybody here in Canada. My wife and I have been binge watching Bridgerton, the latest season to come out, and so it reminds me of Victoria Day. And there's something that's been bothering me this week on the recent breakout. Obviously, inflation data came in softly, and equity markets broke to the upside, and all the doves be doves. Everybody kind of jumps on the bullish bandwagon, and we saw a bunch of upgrades and price targets this week. But let's take a dive into the chart room, and specifically the ledger of the U.S. government, and see what's keeping me up at night. Twice a year, the Congressional Budget Office updates their forecast, and so we're expecting another update in the next couple of weeks here. The February update, May update. So these are the February forecasts for the U.S. budget for the next decade, actuals in the rearview mirror, and fiscal outlook going forward. They're forecasting, without a recession at all, a structural deficit as a percentage of GDP in the 5 to 6% range, like as far out as you want to look. Okay. And so that translates into, trillions of new bonds and bills that need to be issued every year. And of course, the more they issue, the more they've got to pay, and so forth, and it keeps getting worse and worse and worse. So what do you do with this structural deficit? Okay, and how do you make it go away? Well, you've got to raise taxes, or you've got to cut spending, and we're in an election year, and good luck with any of that. And it almost doesn't matter who wins. Trump spent as much or more money than Biden. And go back government over government over government. Some are slightly better than others. Some are a little bit more fiscally prudent than others. But the reality is they're all crap at managing our tax dollar. And government in general is wholly inefficient. Don't get me started. Into the chart room we go. So in recent weeks, we showed this graphic before. So this is the total federal debt outstanding measured in trillions. So this is in 335,000 billion, so $35 trillion. And so that is not the outstanding to the public, that is the gross outstanding. And as a percentage of GDP is now 125%. Just an incredible number. U.S. economy is approximately 27 trillion right now, $27.5 trillion. So you can see where the math's coming from. About 1.2% of 120% of GDP. This is the yield to maturity of all the outstanding debt. And that's currently 4.59%. And this is the coupon, so the actual interest payment. And this line is going up, and with all that deficit yet to come, markets celebrated a couple of weeks ago that in the quarterly refunding announcement, Yellen again was going to fund the deficit with more bills, and that's almost like printing money. And it's not a stress on duration assets. this problem isn't going away, as you could see. As far into the future as you want to go, they're going to have these massive deficits, and that's just going to be a headwind to economic growth. So when it comes to the bond market and what we did in our bond portfolio this week, so we saw TLT rally in the last couple of weeks. Again, following the QRA, TLT was trading at around 88. Got up to 90, over 92, 92 and a half earlier this week. On Friday, late in the day, it's selling off a little bit. We actually sold some calls for 98 out to October, again, just in front of the next quarterly refunding. So we've sold 93 calls for July, again, before the next quarter, and now we've gone out again. And so what we're doing here is we're saying if TLT keeps rallying, we're going to hedge that duration risk in our portfolio. In other words, all this massive supply is not going to allow the bond market, the demand for duration, unless we go into a very hard landing, okay, and that's the key, unless we go into a very hard landing, is not going to overwhelm all the supply that's a virtual certainty. Okay, again, unless they can fix things politically, which we know they're not going to be able to. So that leads us to then what should we pay for equity market risk? And so my friend Brian Belsky this week upgraded his target, and he's now, what he quoted in his note, I love the way he does this. He says, we're now the highest on the street this year. And I remember working with Jeff Rubin over the years, and when oil prices were going up first over $100, and they had a front page story on the ROB with Jeff there talking about oil going to 200. And I said, Jeff, I'm looking at the charts and I got 125, maybe 140 as the next technical target. He goes, yeah, but if I use that number, I wouldn't get on the front page of the of the newspaper. So a lot of these strategists like the media coverage. They like to be the big number. The rationality for it, Ed Yardeni, who we know has been very, very positive on markets, almost universally positive on markets, came out this week and said, his 6,000 target for the end of 2025 now makes sense. Anyways, I look at these things and I just wonder, what are we paying for it? So based on where and our earnings are still good, but again, should we be paying 21 times for that, given the cost of capital, given the risk of a hard landing, given the higher for longer message, given that I don't think inflation is going to come back down unless we get a hard landing? So stocks remain priced for perfection. There's a lot of noise in markets, and us more cautious investors who have a value tilt and don't like to pay a ridiculous amount in terms of a multiple from a risk perspective. Anyways, I get criticized a lot about being, that bear out there, but really it's a value tilt that I have, and it's caution. So, the message remains, be cautious. The message remains, there's always stuff to buy. With options expiry this week, we have a yield portfolio that generates north of 10% a year in terms of tax efficient yield for investors. And every month we just find names out there in the universe where the risk return's attractive. We write puts on them. We earn a lot of income. We're on a tax efficient income for investors, and we take far less risk than buying the S&P 500 at 5,300, on this breakout. Technically, yeah, it should probably go a lot higher, and it may very well do that in the short run. What's going to change that? Well, it's really the next economic point that may suggest inflation is not well contained, or we might get a hard landing. Walmart, in their earnings report this week, told us that even the higher end consumer, and they can tell by the types of credit cards that are being used in their stores and various other metrics they look at, but even the mid to upper income earners, they're starting to grow their market share, because even the higher earners are going to Walmart because they want their dollar to last longer. So, we saw leading economic indicators, by and large, are telling us a harder landing is coming, though not here yet. The claims numbers, again, came down a little bit. So that scare we had a week ago that maybe the new trend higher was there, probably not. So you've got this, you've got Goldilocks isn't the right word, but you've got this, vortex we're in. Think about a hurricane. We're in the eye, and it's whipping around us of uncertainty. And what is that ultimately going to mean for markets and risks? So I think investors, you got to be cautious. I said months ago that I shifted my entire public market security portfolio into privates so that I could still get the yield and income and growth that I think I can get without the volatility that's associated with some of the manic phases of public equity market investing and bond market investing for that matter too. Anyways, that's where I'm at. Have a great long weekend, everybody. No BNN show this week. We'll see you the following week. Have a good one.